In this video, we're covering a crucial topic that every business owner must face: choosing the right entity for their business. Let's explore your options and the implications of each choice. Choosing the right business entity is a critical step in setting up your business, as it directly determines how your business will be taxed, the level of personal liability you'll assume, and the regulatory requirements you'll need to meet. The right structure provides valuable tax benefits, protect your personal assets, and it can even influence your business's credibility among customers, vendors, and potential investors. Failure to choose the right business entity can have significant downsides. For instance, if you choose a sole proprietorship or partnership, you could be held personally liable for business debts and liabilities. On the other hand, if you set up a corporation when your business is small, you might end up dealing with extensive paperwork and complex legal and tax requirements that can be overwhelming and costly. Moreover, some structures may result in higher taxes if not properly managed. It's crucial to weigh the pros and cons of each entity to avoid potential risks and make the most out of the opportunities your business has to offer. Starting with the simplest business structure, we have sole proprietorships. This is an unincorporated business owned by one person that has no liability protection. While it's the easiest to set up because the sole proprietor and business are one and the same, a sole proprietor could be held personally liable for debts and liabilities of the business. There's no legal distinction between the business and the individual, meaning personal assets could be at risk if your business faces financial or legal problems. Many entrepreneurs start out working as sole proprietors, but eventually graduate to a more complex entity as their business expands, mainly for the limited liability and tax strategies available to them. A partnership is formed when two or more people decide to go into business together. It must file an annual information return to report the income, the deductions, the gains, the losses, etc. from its operations, but it does not pay income tax. Instead, it passes through profits and losses to its partners. There are two primary types of partnerships: general partnerships and limited partnerships. In a general partnership, all partners share legal and financial liability equally, including profits, losses, and liabilities. In a limited partnership, at least one partner is a general partner with full personal liability for the company's debts. At least one other partner is a limited partner who typically does not participate in the day-to-day operations and whose liability is limited to the amount invested. An LLC combines the liability protection of a corporation with the tax advantages of a partnership. LLC members are protected from personal liability for business decisions or wrongdoing of the LLC, which means that the personal assets of the members are shielded from creditors of the business. Just like a partnership, the LLC profits avoid double taxation and are typically only taxed on the members' tax returns. When compared to a corporation, they're typically easier to set up and manage, requiring less annual paperwork and record keeping. An LLC can be classified as a pass-through entity. When done this way, income and losses are not taxed at the company level and instead are passed through to the individual members and reported on their individual tax returns. An S corporation, or S corp as it's commonly known, is a type of corporation that acts as a pass-through entity for tax purposes, meaning it passes income, losses, deductions, and credits through to its shareholders. It offers the limited liability advantage of a corporation and has similar tax advantages of a sole proprietorship or a partnership. In an S corp, you can minimize self-employment taxes, as only the salary paid to the owner or employee is subject to employment tax. The remaining income passed through as a distribution is not subject to self-employment tax under the IRS rules. When compared to a sole proprietorship or single member LLC, you could save on self-employment taxes through an S corp. Additionally, business owners who plan to transfer the business to family members may find an S corp advantageous because it can help with estate planning. For example, owning shares in an S corp may allow for valuation discounts and favorable business tax treatment upon death, reducing the tax burden on the estate. However, S corps also have certain restrictions, such as a limit on the number of shareholders and restrictions on who can be a shareholder. A C corporation, often simply called a corporation, is a type of business entity that is considered separate from its owners or shareholders for tax and legal purposes. It can have an unlimited number of shareholders, making it a popular choice for businesses that plan to expand or go public. Unlike S corporations or LLCs, C corporations are subject to double taxation. This means that the corporation's profits are taxed at the corporate level when earned, and then taxed again at the individual level when distributed to shareholders as dividends. However, despite this downside, C corporations can reinvest profits in the company at a lower corporate tax rate. C corporations also provide their owners with a degree of liability protection. Shareholders are typically not personally responsible for the company's debts and liabilities, so their personal assets are protected. If a company intends to seek venture capital funding or offer stock options to employees, they might benefit from C Corp designation. Additionally, businesses planning to reinvest a significant portion of profits back into the company, or those that aim to go public in the future, may find a C corporation to be a viable choice. So here's a breakdown of who might consider each type of entity. So a sole proprietorship. This is the simplest form of business entity, and it's typically suitable for individuals who are the sole owners of their business. It's the easiest to set up and gives the owner complete control over the business. However, the owner is personally liable for all business debts and liabilities. A partnership is popular for businesses with 2 or more owners who want to share both the responsibilities and the profits of the business. There are different types of partnerships, each with their own level of liability protection and tax implications. An LLC can be a good option for owners who want the liability protection of a corporation, but prefer the operational flexibility and pass-through taxation of a partnership or sole proprietorship. It's a popular choice for small to medium-sized businesses. S corporation. Businesses that want to avoid double taxation but still enjoy the benefits of a corporation might opt for an S corporation. This type of entity allows profits and some losses to be passed directly through to the owner's personal income without being subject to corporate tax rates. However, there are limitations on the number and type of shareholders. Larger businesses or those planning to go public, seek venture capital funding, or offer stock options to employees might choose a C corporation. While C corps are subject to double taxation, they can reinvest profits in the company at a lower corporate tax rate. Plus, they offer a higher level of liability protection for owners. If you're watching this, you should likely engage a professional to help you select which entity makes the most sense for you. At Compound, our goal is to be your trusted partner throughout your business journey, from inception to exit and through retirement. We understand the challenges business owners face when starting their business and choosing the right entity. We're here to make the process as seamless as possible. Our team of financial advisors and tax experts work alongside you, understanding your financial situation, your business, and your business strategy. As part of a comprehensive financial strategy, we'll help you choose and then set up the right entity. Allocate your investments tailored to your goals, project future cash flows, and track your net worth. Sign up for the dashboard or schedule a free consultation to hear how our advisors can help you navigate your journey from inception to exit.